This Thursday sees the ECB step forth with an all but guaranteed 25 basis point cut from Lagarde and co. It's an interesting time, of course, given the threat of tariffs. One minute they're on, next minute they're off, and the direction of travel in terms of inflation, given the decline that we've seen in terms of energy prices. So let's look at this ECB meeting, what could come out of it, and how we're expecting to see the euro and the DAX move in the aftermath of the announcements. So let's kick off with market expectations for the meeting. As we can see here, essentially, it's near enough a 100% chance of a rate cut this time around, 25 basis points in that. Certainly the fact that Donald Trump has rolled back the so-called reciprocal tariffs from all but China means that the eurozone isn't necessarily in as much of a dire situation as they had previously thought, or desperate situation, call it what you will. And so certainly we're in a bit of a better position right now. Of course, there's this perception that we will see greater fiscal stimulus going forth, but nonetheless, the ECB will need to act and continue to act as they want to support the strength of this region, given the breakdown with trade with one of their major trade partners. And of course, with inflation coming towards the downside, it means that they have the means to continue to do that. If you look beyond this meeting, you're looking for another rate cut in June. And then from then on in, we get greater uncertainty over exactly where that so-called neutral rate is, where those interest rates are going to stay, essentially. And just because we're pricing it currently around that sort of 175 mark doesn't necessarily mean that that's where it will end up being. Of course, it comes down to the economic developments that we see between here and then. So one thing that's been notable recently is the movements we've seen in terms of yields. Ever since that announcement from Donald Trump around the tariffs, we've seen a spike in terms of yields elsewhere, but not necessarily in terms of eurozone yields, with the German bunds at the bottom, the yields continuing to move towards the downside despite the spike that we have seen in terms of yields elsewhere, notably within the US, that we saw that initial pullback for the US, but then we saw a major surge as we saw significant fears around recessions around the world, a lack of economic confidence. But in Germany, there is a feeling of optimism, certainly centered around the idea that they're going to be borrowing more, spending more, the same kind of story within the eurozone as a whole. And so we've been seeing downside in terms of yields, expectation that we're also going to see downside in terms of rates. Now, manufacturing also highlights that things are picking up a little bit. You see that eurozone manufacturing PMI on the bottom climbing of late. So interestingly, coming at a time where you're expecting to see the manufacturing sector and the sort of goods businesses within the eurozone really coming under pressure from Donald Trump and the like. In actual fact, we're seeing a recovery of sorts that hasn't really been taking shape for the last couple of years. So in actual fact, the eurozone looking in relatively better shape than some people had been expecting. In terms of the trajectory of rates, part of it will come down to the fact that they already have been very accommodative. You can see here with the deposit rate of the ECB in the orange line, below all but the Swiss National Bank, you can see at the bottom. So we already have seen a significant degree of easing. You can see that the peak, well, the beginning was lower than the rest, the peak was lower than the rest, and then we're coming down. So, save the SMB. But the question mark here is, how far can we go? And certainly, as we've alluded to, 25 basis points at this time, 25 probably the next time around. And then from there on in, there's some uncertainty over exactly where we will finish for the ECB. Unemployment has been also showing some signs of improvement. You can see that the overall trend over recent years has been a sort of gradual move towards the upside for many of these developed nations. In actual fact, despite the fact that it has been the highest out of many of its peers, the eurozone unemployment has actually been gradually grinding lower. So certainly it has spent a fair amount of time feeling like it was the weakest economy out of the lot. But gradually things are showing signs of improvement. Now, notably, we have seen this uptick recently in terms of inflation pressures in the eurozone, and that's highlighted on the top end here with the light blue figure that we can see for March, a sharp rise, and also a relatively decent figure for February as well. We've grown quite accustomed to the idea that inflation within the eurozone has pretty much dropped to a point where the ECB can do what they want. And like I said, we are likely to see further disinflation coming from the efforts of Donald Trump in terms of driving down energy prices, with the likes of WTI falling to a 4-year low recently of $56. And so that could provide some disinflation. But it's notable to see that we have seen this uptick in terms of the 6-month annualized figure, which has been rising back towards the pack. It's still currently at 2.29. So they're still there or thereabouts when it comes to inflation. That allows the ECB to do what they want. And certainly part of it is going to come down to this view of, the potential economic weakness. Tariffs do bring the possibility of inflation if we see the sort of tit-for-tat trade war within the eurozone to the US. But at the moment, the eurozone wants to hold off and see what the US is doing. And the US, beyond the auto tariffs, which they've already said they might actually make some changes to, and the 10%, which is blanket, they haven't enacted the additional 20% that was previously touted for the eurozone. One interesting development that we've seen recently is this blowing out in terms of some of the relationships when it comes to yields and currencies, notably the US dollar, right? So what we can see here is a close correlation between the euro and the US 10-year yield and euro dollar. And so that was, something that we've been following very closely. This chart highlights just what a dramatic move we've seen recently. People talking about this basis trade blowing up, but essentially what we're seeing here is the move higher in terms of yields, the move lower in terms of the US dollar, and the sort of blowing up of that relationship, so to speak. Now, it's not necessarily like that so much for the likes of euro sterling, because we can still see that there is, despite a little bit of divergence at one point, we are still tracking relatively in the same direction. So that highlights how if we see further downside in terms of yield differential, then you'd be pointing towards a possibility of weakness in terms of euro sterling. But by and large, you can see that it's been holding up relatively well in terms of that German to UK 10-year yield, sort of rotating somewhat. So does that point towards the idea that that decline in euro sterling sort of run away with itself a little bit? Well, it's interesting to note that we have actually recently been seeing a little bit of a pushback against that. And so let's bring up the chart for euro sterling just here. So this is euro sterling, and we can see that ultimately this pop for euro sterling over the course of this month moves us out of this downtrend that has been dominating with this descending trend line, breaking up through your swing high that we have at this point here, which the breakthrough 84736 alongside that descending trend line does point towards a possibility of further upside to come. And certainly there's question marks around, where this terminal rate will be. There's the fact that we are seeing some improvement in terms of some of these economic data points. Will the eurozone soon enough get to a point where the rate cuts come to an end and we instead look towards maybe the UK to start really ramping up their rate cuts in a more meaningful manner? That could therefore sort of strengthen euro sterling. And we have seen this rebound coming into play. Now, notably on the monthly time frame, you can see that rebound came from this zone of support where we have a number of lows, right, between sort of 8.2 and 8.3. And so there's a good chance that we have bottomed out here. So look out for, of course, the tones from Lagarde and co. But if we see unemployment continue to fall in the face of rising unemployment elsewhere, if we see people moving into German bunds and moving out of other 10 years, if we see the growth prospect lifted and Donald Trump continuing to hold off the reciprocal tariffs, it all feeds into a potentially positive narrative for the euro. Of course, we've pulled back. Half of the gains that we've seen this month have been retraced. But if we look at the sort of shorter time frame, we can see as we work our way in, we could see a retracement phase, but there's a good chance that we have bottomed out here. That retracement phase comes into question with this move here, right? So a breakthrough 851 or 852 kind of area would point towards that wider retracement coming into play. We could then get it onto the fib and say, right, where would we be looking at? Roughly, let's get that a bit more on point. There we go. So, your deeper fib levels already drawn on here. When we're looking at sort of your 50% retracement, let's see. Not sure why that's not popping up. Irrespective. So you're going to be looking somewhere around your sort of 0.851, I would say, for your 50% retracement. But essentially, you can see here, there is a possibility that we come into what would be a potential trendline support down here between the 61.8 and the 76.4. Of course, this trendline has different ways of drawing it. You can draw it the way that I've got it on there with a number of touches, but you can also sort of grab it and put it, there we go, roughly sort of up there as well. So you've got this sort of fan of support, which sort of tallies up with this 76.4 and 61.8 fib. So there is a possibility of further downside, and certainly if we see a relatively dovish stance and a rate cut from the ECB, which markets think is pretty much guaranteed, then yeah, maybe we see some further downside. And if we break in particular this 851, 852 kind of zone, then it points towards this deeper retracement coming into play. But I do think there is a possibility that we've possibly bottomed out once again, and that this range that's dominated since sort of 2017 comes back into play once again for euro sterling. And finally, let's look at what's happening in terms of the German DAX. Now, the DAX has, of course, pulled back very heavily, much like most markets out there. But look at that for a candle, right? It's recovered a really significant amount of that, and it highlights the sort of buying pressure that has been taking place of late, notably rebounding off of this ascending trend line of support in between the 76.4 and the 61.8. So that's playing out absolutely perfectly. I mean, ultimately, very clear here where your swing lows are, and so we've come into that deep support level. I think there's a good chance that essentially that selling pressure is done. So if we do see a resurgence of it, let's say it's led by weak earnings, weak outlooks from earnings, economic data that points towards a slowdown in the US, things like that, that could hit equity markets over the near term. So I certainly don't necessarily think this is a straight line move back up to record highs. But if we do see those kind of bits of news and we roll over, I think personally that this is likely to be the low of this move, as you can see, in line with this sort of wider trend. It's got reversion back to that mean trend line. And so near-term pullbacks, I think, are likely to be short-term in nature and potentially a retracement before we see the bulls stepping in once again. For the near term, you can see that we are sort of trying to create this higher low situation once again. Let's just get this drawn on. So as we can see here, you've got a move into 76.4 fib there. Then this current move into the 61.8 here, and now moving higher. So the bulls are back in charge at the moment. Keep an eye out for a potential move up into, let's just see on the top end of this, we've got this potential trend line resistance coming into play up there. So that's an area to be looking out for, which is around your sort of, well, it depends obviously because it's dynamic, sort of 21780 at the moment. So at the moment, it appears the bulls are back in charge. There's certainly the possibility of sort of humps in the road, volatility down the line around announcements for the resumption of some of these tariffs, you know, that there's a breakdown in trade relations between the US and the EU, potentially things that signal that we're heading for a recession or a resurgence in terms of inflation. Those kind of things could hit sentiment. But in terms of this ECB meeting, I think the narrative is going to be around being accommodative, being data dependent, but markets will also be keeping a close eye out for signals over exactly where that neutral rate will be and where these rate cuts come to an end. I hope that's been useful. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day.